I just needed to be patient for a long time. And that's really the trick, because it's hard.
Even if you're not having, say, financial success now, again, like bringing it back to investing, if you look at what you're doing and say, okay, well, look, I've actually learned some lessons.
Not your dollar signs in the bank account by which you should be measuring that net worth.
You've got like influencers renting, mansions and supercars and like in like fake airplane, like private jet fuselages to take like content to make their life look so incredible.
For an advertising-free version of this show, check out wallstreetwildlife.com.
Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Krzysztof the Monkey. This week, are we in the midst of degeneracy gambling culture as investors? And is it getting worse? Also, how PE ratios could be a misleading indicator as to whether the market's overvalued. But is Axon overvalued anyway? Krzysztof's going to tell us about Oddity, doing a bit of technical analysis and also talk about the fundamentals. Plus, we have both made options errors with Cipher, Quantum Computing Inc. and Coherus. And I've got a bunch of options expiring worthless this Friday. Krzysztof's going to give us a teaching of what we did wrong.
Yes, sir, Badge. Before we get into all that goodness, let me tell you something, buddy. You are very lucky to even be talking to me this morning. Because I have been in the options course design dungeon for like 18 hours a day for the last 2 weeks. Barely saw sunshine. I smell real bad. There's flies buzzing around my head. I'm borderline degenerate. We'll get back to degeneracy in a bit. But the fact that I could almost clean up to make it for our recording, count your blessings.
Very kind of you. Looking forward to seeing the options course. We're going to talk a bit later about it. But yeah, you've been working super hard on this. And we're going to be doing a pilot run for 8 lucky Patreons in like the next few weeks. We're kicking off.
Yeah, I mean, and it's wild. You learn 50 times as quickly when you have to teach something. So I've gone into so many corners and I couldn't be more excited. I couldn't be more excited about what I've been cooking up. Meanwhile, you, my friend, have begun season. This is an annual Badger tradition, yeah? Sporting maybe one of the fanciest bits of Wall Street Wildlife merch. Yeah, where's my fancy Wall Street Wildlife ski jacket?
Yeah, well, you got to make your own merchandise, right? Like this podcast, don't make it sell.
What kind of operation are we running here? Got to make our own merchandise.
Yeah, like I reinvented my life like 5 years ago so that I could do 3 months in the mountains every year. So yeah, delighted to be back in snowy climes for another couple of months this winter.
Excellent. Good to have you. Badge.
Hey, do you know what I did last night? This might please you. I'm in ski season with a buddy, Dave, and I sat him down and I made him watch one battle after another. So I watched that again. What a great film. It's actually better on a second watching. You're right.
Isn't it amazing? Yeah, I saw it for the second time over the holidays. It's just, you could see the humor too a little more when you could see DiCaprio's character as just a guy. He just keeps going, right? He just does the next thing well enough to I mean, yeah. Oh my God. Delightful.
Awesome. And they just won like Best Motion Picture at the Golden Globes yesterday. So.
Oh, is that right?
Yeah.
Oh, cool. Yes. Obviously, deservedly so. I'm not one to proselytize often, but I've been screeching from the treetops about one battle after another for sure since I've seen it. Not least because my main man, literary love, Thomas Pynchon, wrote the base book, which most people don't know, called Vineland, from which was adapted.
You're not gonna tease me to read the book, but I will tell you because it came up in a predictions episode last week. I have already read 2 books this year, and it's only January the 12th. So
you have not.
Up yours. I have.
You have not. What are their titles?
One is a reread. It's a sci-fi book called Hyperion by, I think, Dan Simmons. It's like it's one I go back to every couple of years. It's good. It's a good like quadrilogy. And the other, actually interesting, I kind of half read it because I didn't get anything out of it. It's going to be controversial.
Wait, hold up, slow down. When you say what do you mean half read it?
No. I read that. I read Hyperion. I enjoy that. I half read the second book, which is The Art of Spending Money by Morgan Housel. Yeah, I don't know. I mean, it might be controversial. Like, I like Morgan. I enjoyed The Psychology of Money, but it feels like a one or two idea book that could have been like a blog post, not a book.
Interesting. Does half reading something count as having read it?
All right, I'll read another book before the end of January, so I'm going to hit your prediction, like 2 books by the end of the year. Anyway, apologies to Morgan fans. He's a good author, but like, I don't know. This one feels like a lot of pages with not a huge number of ideas.
Well, you teased us enough. I know this wasn't planned, but if it's just a blog idea rather than a book, what's the main takeaway?
I think just be thoughtful about how you spend your money. Like, don't live beyond your means. Don't live in like a culture of envy and aspiring to stuff that you can't afford. Spend money on experiences, not stuff. Kind of, yeah. There's more to it. I got through the first couple of chapters and I just started like whipping through it, and then I got Gemini to summarize it for me.
Although, it might have been blasé for you because you live this model, sure, and you've been living it for so long, it probably feels like, swimming in water. Many people, we forget, are actually caught in these traps more than, the wealthy poor. The people that make a lot, but they're scraping by because they're making such disastrous decisions about how they value, what they value, why they overvalue a 7-room mansion or whatever when, it's has nothing to do with their quality of life kind of stuff.
Yeah, perhaps. Well, yeah, actually, this is an interesting segue, right? Because maybe this brings us nicely onto your topic of degeneracy.
Yeah, so in our show notes, we're going to put links to 2 posts on X that were making the rounds, and I found them fascinating. It's the first poster was making a claim, which initially I posted also on our Patreon. It got me thinking. The basic claim, more or less, is that this current generation, born into obviously not just the age of the internet, but the age of AI, housing costs have doubled. Wages aren't keeping up. He's making the claim that mathematically you can't catch up because the system is already too rigged.
Yeah, like, to bring it to life, I read the article like a couple of weeks ago, but it's like housing, a good example, where there's like a lot of housing wealth in like baby boomers and older people who got on the housing ladder. And now if you're like in your 20s, you're coming into the workplace, even if you've got a good salary, you just feel like you can't really get started in life.
Yeah, and I for the most part, I buy that argument. So I kept reading, Then he makes a transition to say, what this generation again sees all around them is, in social media terms, that poison of comparing themselves to what looks like everybody has more than you do. So you're not, you don't have a house, you're not keeping up, but everybody else somehow is, right? That psychological state. Then he layers on top of that, oh, by the way, this AI thing is coming. And it ain't good. It's not like, from this perspective, not like jobs are going to be all of a sudden more bountiful. It's like, no, there's an overlord coming and you better watch out kind of feeling, right? So his conclusion is that this is leading people to becoming more or less degenerate gamblers, not necessarily because of, let's call it for short, deep problematic psychological addictive habits, but because of the structural position they've been put in. His conclusion is it's better, therefore, to take a 1 in 20 chance on some degenerate call, right, with the hope that you could overcome these limitations, than to simply die and let the AI and the system eat you alive. That's his claim, right? Ultimately, he ties it, I think, for our investing purposes. He therefore said, okay, what do you do with this as an investor? He's like, okay, you basically invest in the gambling sites, the sites that take a little bit of rake from every transaction, like, for example, DraftKings or Coinbase or Polymarket, obviously being the latest fad.
Or maybe, and maybe we'll get just a sidebar a bit. Maybe we'll loop back to this later in the conversation. Like you might, if that is your thesis, like society is screwed, people are gambling from necessity, therefore I'll invest in the gambling sites. You know, maybe that's like immoral. Maybe that's, you know, tantamount to owning like tobacco stocks or, you know, whatever your kind of principles might be in life. But anyway.
Yeah, absolutely. Absolutely. So anyway, I posted this on Patreon because I thought that half of actually said, I think, quote, this is worth reflecting on, to our patrons. What's interesting is that when you read the comments, many people were like, yeah, right? This is, okay, I got to go all in, right? I got to now become, you know, more of a degenerate. That's not what I was saying. I didn't comment on it much more besides, let's reflect on this. And then not too long after, I read a second response to this, which hit me even harder. And I thought it's more aligned with what we're talking about. It's not an outright denial that these are issues. These are issues, and we don't know exactly how they're going to unfold. But his response was quite different. It wasn't double down on the degeneracy. It was take a step back first and realize, and I'm going to paraphrase and maybe add my own 2 cents here, that adding skill sets now has never been easier than at any time in the history of humanity, as long as you have access to, call it, the basics, an internet connection, right? And maybe hopefully if you're not, you know, in a really developing country, like a bank account, if you have enough to pay for some subscription, like a GPT or whatever, you'll be more than fine for this purposes, right? So compounding skills now is the way out. The problem is, Badge, I know your ears are already burning. It's that word compounding. People in general don't have enough patience in the degenerate kind of culture to put in, let's say, a year or 2 or 3 of skill acquisitions so that they could see how bigger it gets in the 3rd year. Does that make sense?
Yeah, totally. And it's, you know, it's fueled by that social media dynamic. You know, you've got like influencers renting, you know, mansions and supercars and like in like fake airplane, like private jet fuselages to take like content to make their life look so incredible. And that, you know, you see on Instagram, you see like these young guys and girls living this incredible life. And then that drives you to this, like, I've got to be in a rush. Like, how come these guys have succeeded? And I'm like, they're younger than me. And like, why is it taking so long for me? But you can't get rich quick. Like, you know, if we bring it back to investing, but you're right about building skill set as well. You know, you got to put the work in and the foundations in. And it's not a couple of years, it's like a couple of decades to get to the point that compounding, you know, really starts to take off. Took me, 10 or 15 years before I got to the point that like my investing returns in any given year were on average more than my salary. And that's the point where like the steamroller really started to roll. But you can't just fast track your way there. If you could try and gamble your way there, if you're lucky, well, probably, you know, 99 other people were unlucky and you were the lucky one.
Exactly. So we have the problem and the solution sort of already. To me, it's quite clear. You could either go for the quick win, the quick kill, but that has a negative expected value by design. You're betting against, you're playing against the house. You're not going to win. Or, I'm sorry to use myself in this example, but it's so close to home. I was telling you how I've been, you know, cooking this options course nonstop for the last 2 weeks. I'm my mind is just continuously being blown at what is now available to these paws if I just like sit in my seat, buckle in, and then when the first thing doesn't work and this thing breaks and that thing blows up, if I just continue focusing in using the amazing AI tools to help me fix the things that are breaking. In other words, I'm saying this is a character issue. This is like, can you just just learn the hard way, learn the old school way, and not give up and continue sort of grinding? Then with that mindset, my God, there's nothing that's not possible for anybody. So that's kind of pushback number two. And then the main pushback number two is he says, just reject the social media comparison machine. And for me, as a Buddhist, philosophically grounded person that swims in the water of money is not the solution to anybody's problems, we talk about this nonstop. It's your character and it's what you do with the money, aka how it opens up time and friendships and experiences. That's the solution. So if you just get away from that social media nonsense, then the degeneracy bit basically stops being as toxic to you.
If you're optimistic and you look at even if you're not having, say, financial success now, if you can look at what you're doing, again, like bringing it back to investing, if you can look at what you're doing and say, okay, well, look, I've actually learned some lessons. I may have underperformed the market. I may have lost money like in the last 2 years, but I've learned a lot and now my process is better. And so like I'm still moving forwards.
Right. Absolutely. And so the ribbon, I think, on this exchange was this particular responder replied actually quite explicitly with, you got to double down instead with something like faith. And he actually talked about his own Christianity, which is perfectly fair, I think, in this context. It doesn't, I think the bigger point is whether it's Christianity or whether it's, pick any of the candidates for how people find faith. The point is the same. It's not your dollar signs in the bank account by which you should be measuring that net worth. And if you fix these basically three orientations, then I think the degeneracy impulse will be much less existential. It won't feel as, oh my God, I have no options. I have to take this, crazy bet. You know what the irony is, by the way, as I'm talking about all this? Polymarket just went live for me in the US. I got off the watch list. And so I threw in like $25, and there's some football games. And it's just astounding how easy it is now in all the ways to just bet on everything. And like, oh my God, it's just what a wild world. This is the next frontier that we'll be dealing with. So anyway, that's another topic.
That's cool. It's cool. We've had that stuff in the UK for a long time. Some app called Betfair, which kind of does a similar thing, peer-to-peer betting, and you can bet on like the next point. Doesn't have to be like the whole match, and you can bet on random stuff. I think that's, if you treat that sort of aspect of gambling as fun and entertainment, I think that's okay. It's healthy, as long as you don't let it spill over into like dominating your finances.
Yeah. And you know what? Actually, because we're also designing our Las Vegas outing for our Wall Street Wildlife Patreons, March 27th and 28th, kids, mark your calendars. In this moment, Badge, I do want to subtly point out that there is probably, to me, it's this gray area of where the surfer rides the wave. And the analogy for me is the poker tables, because it has elements of both gambling and it has elements of skill. But in order for the skill to show up, you need the proper time frame. And that's why people they confuse, right? They look at what is poker exactly. And it really depends on the view they're taking. If it's a one night thing, it could be a degenerate gamble. right? But if you approach it a different way, it's not. It's a compounding mechanism that displays your skill set over time. And same thing, right? And so I wouldn't rush. Maybe Monkey's, moral of this story is don't be quick to judge, call it the technology or the platform. First, figure out what your relationship is with that thing, how you're using it, and that'll probably get you off on the right path.
All right, interesting stuff. So let's get our hands dirty with like companies and real investing stuff. So you're going to tell us about asset bubbles.
Yeah, topic du jour, du month, du last year is the AI bubble, right? I found a more interesting take on this. Not denying that we're in the bubble. We're obviously in the bubble, if you wish. I don't need it. Maybe it's that word that's problematic. More useful, I think, to think about. It shows 5 different historical periods during which there was a massive paradigm shift in technology. So railways in Britain in the 19th century, then we had the 1920s with cars and electricity coming online. Then there was the 1980s. I don't know what happened in the 1980s. That was technological shifty. Obviously, the 90s, we had the birth of the internet and everything moving online. And now we have AI. The point of this chart is to say these kinds of massive revolutions take a while to play out. And if you look historically at I guess it's all relative, at when the technology started to when the bubble peaked, then you have a better sense of more or less how much longer do we have before things actually naturally course correct. And according to this chart, and I think my thesis is that, yes, there's a kind of froth and excitement because it's warranted, but we're also historically early, or not, maybe early isn't the right. We're certainly not at the peak of where the technology is either via valuations or maybe because everyone's already doing the thing. So we're not there yet. So therefore, from an investing standpoint, right, you have to hold two things simultaneously.
If you were in any of those other bubbles, it probably didn't, like, if it didn't feel like a bubble when you were in it, and at any point in, like the NASDAQ in 1990.
I disagree.
Yeah. Maybe we are. Yes,
oh my God. Well, during the one that I lived through as an investor was the internet stuff. And that there was no question. I was 22 years old, and I was looking at my mini portfolio, and I was like, oh, up another 34% today. That's easy. There was no doubt. Some bizarre stuff was going on. I think the takeaway here, though, is for us, it's less of this binary thing. It's not, are we or are we not in the bubble, where something's obviously happening, but how much longer can we reasonably expect for things to be, I don't know how to phrase this exactly, not for the bubble to pop, but for the wave to continue creating things we've never seen before, which in a way justifies more investment and greater, CapEx and so forth, until eventually, of course, there is that peak where, okay, now this is just Palantir level silly kind of stuff where everything is like on that kind of peak. Then we're like, okay, it's probably time to look at it.
Is it interesting you point at Palantir? Because my takeaway here really is it's quite hard to draw conclusions and look at the whole market. Like, if you're an index investor, okay, you do own the whole market. If you own the all share and the S&P and a few things, and you're well diversified. So some of these conclusions might actually be relevant to you. But that's not our game, and it's probably not the game of the majority of our listeners. Like, we own individual companies, we own stocks, and maybe it's a kind of false dichotomy. I don't know if that's the right use of that phrase, but apply like these big market sentiment things to our own companies. Like, I like to look at the companies I own and try and form an opinion on their valuation. And I did that for Palantir. And, I formed the view that actually it's probably overvalued, like it's fully valued at least. So I've really reduced my stake. I'm going to tell you a bit about Axon in a minute. And like, I've got a similar conclusion around that.
Yeah, that reminds us, sorry to bring back this old horse of ours, but a moment where you and I were both very sadly mistaken because of this lens was NVIDIA. And we both did our research and understood that this thing is going to be like wowzers amazing. But we, if I may speak on behalf of both of us, we got, in a sense, too rationally, not sure, but like convinced that the wave, the valuation thing, just, it's too high. It's the classic error of knowing too much, I would say. And then you forget that paradigm shifts like what NVIDIA brought in don't happen very often. And so we sold too early because we thought, okay, this is too expensive now, and so on and so forth. And so this is why this is a tricky thing, like Palantir is just, to bring that back, it's just so off the charts, peakish, that I can't blame you for selling it. I mean, I tried shorting it for a little while, which was also kind of silly. I got lucky that I got out with a little bit of profit. But peaks, bubbles, you got to put many asterisks when you're in the once in a lifetime kind of phase shift.
Yeah. And like, the way I navigate that, and like, there's a lesson here, is you don't have to be black and white. You don't have to be like fully invested or like out of the stock entirely or even shorting it. Like, there can be a gray zone. If you think something's like a bit overvalued or like incredibly overvalued, just own less of it, but still keep some exposure to it. Because if you believe that company is like defining the future, then, you want some skin in the game.
Yeah, agree. Proper portfolio risk management and so forth. Badge.
Should we bring this around to like PE ratios? Because there's a really interesting topic came up on our Patreon, I think just last night, actually. This is a really interesting article that Tom posted for us, and from a guy called Manu Invests. And the sort of core thesis, so this picture we're looking at on the podcast now, this is like PE ratios over time going back to like the 1980s. And maybe like, what is a PE ratio? Like price to earnings. So essentially like how much value, how much real dollars does a company generate after paying all the bills and, running the firm and doing everything it does, like the real money that's created, the earnings, as a proportion of the price, like the market cap. And so today...
Wait, Badge, sorry. Can I just one quick thing? The only thing any beginning investor needs to know based on that intro to what PE is that earnings themselves are kind of an accounting... they're an accounting framework which companies can and do easily manipulate because there's lots of variables that go into it. And so when you get more advanced in investing, you begin to look at other metrics because they might be less manipulable. That's all. Just sidetrack. Continue.
No, that's right. And actually, that's kind of the conclusion of the article and kind of, where I am as well. But let's go on the journey a little bit, because like if you're an index investor, so we've described what the PE is for an individual company. And so, the PE of the whole market, which is to say like the weighted average of everything in the S&P 500 is about nearly 30 right now, like 29.8, I think is what the article described. And you could use that. And if you look back through history, like the average PE ratio back in the 1980s was more like 7 or 8. And then, it's this sort of chart that's been really wiggly and it's been up and down, but it's definitely trending up. So you could look at that and you could go, well, historically, companies are being valued at many more times earnings today than they used to be. Like, therefore, the market's overvalued and therefore, we're in a bubble. And so the article's interesting, and it kind of reflecting on what you just said. Accounting rules have changed over the years. So this guy, Manu Invests, points at a couple of examples where, because the way earnings are being calculated has changed, and I'll give you a couple of examples, that has it makes it artificially look like things are more expensive than they really are. And if you back out and you try and do more like an apples to apples comparison based on the accounting rules today as they used to be, then actually things might be slightly overvalued, but they're certainly not like crazily overvalued. So let me just bring it to life with like one of the 3 examples: stock-based compensation. So way back, pre-2006, companies could essentially pay like unlimited stock-based comp to their employees without that really being a drag on earnings. They just kind of created the shares out of thin air. They just printed more shares, and it wasn't reflected. Certainly you're being diluted as an investor, but it wasn't reflected in earnings because of the accounting rules. And now accounting rules have been tightened up, and you do have to account for that, which is like a good thing. It's more transparent, because if companies print a crap ton of stock, then you do want that reflected in earnings. So there's like a pretty significant difference that would more sort of normalize what PE ratios used to be and what they are today. There's a bunch of other factors as well. We'll put a link to the article. But I think it's quite an interesting...
Well, take us through one more.
Sure, yeah, okay. The nature of... Let's do the third one. So R&D. So companies say, you talked about railroads earlier. Like companies, the biggest companies in the world used to be like manufacturing and big like heavy industry type companies. And so they would have to build factories and like have a load of like physical assets, because it's like way pre-software. And so accounting rules will then and now allow you to like capitalize the cost of those, like depreciate the cost of your factory over many years. But the biggest companies in the world today don't build ginormous factories. They build like software. And so software is fundamentally different. It's more intangible. And so like the equivalent of the expense of building the factory is like investing in R&D. And so like the Googles and the Amazons are spending a crap ton of money on research and development, but they don't get to like spread that out over many years. They have to pay for their R&D in the year where they spend it. So again, that's like another factor that makes looking at PE ratios historically kind of not a like-for-like comparison with PE ratios today, because the nature of the business has changed.
Right, and the accounting rules stay the same. It's the same kind of issue in education, right? We're still using an education system born out of the industrial age, when the way we need to teach young people now is massively different. It's the same kind of problem. That's why, actually, most sophisticated investors prefer non-GAAP earnings in accounting, because it actually, ironically, gives you a more realistic vision of what the company is performing based on the new kind of company it is, which is more likely than not software or digital or just very different standards. So, but the point, right? The point, Badge, is if you hear something like the market is wildly overvalued, and look, the PE ratio on this fancy chart says so, slow down a little bit and make sure you're understanding is this apples to bananas, or what kind of fruit are we dealing with?
So we've talked about broad market, but we are not investors in broad market. Like, we are investors in individual companies and trying to draw Like, is the PE ratio of the whole market higher than it used to be? I don't think that really tells you anything useful. So let's take one specific example. And it's a company in my portfolio, Axon, who are like, they're like the prime supplier to most of the police forces in the US, a bunch of other security services. They make like tasers and drones, and like they're really embedded. They're an incredible company that's transitioned from being like a hardware company to becoming more like a software company. And it's been a mainstay. It's like a core investment in my own portfolio, but I think it's overvalued. And so I trimmed it quite heavily maybe 6 months ago. And I got a question on the Patreon a few weeks back. Like, is Axon still, in my view, overvalued? Like, I still own it, but I have a much smaller allocation. So I've popped up a little picture here from fiscal.ai, which is our favorite investing tool. And here's a really nice little graphic. I think I snapshotted this like a week ago, so it might be a tiny bit out of date. The valuation metric I like to use for Axon is price to gross profit, because the company does some, like it pays incredibly high levels of stock-based comp, which kind of confuses earnings. And, it's egregious levels of stock-based comp, but actually it's a bit distasteful. So you can't really use PE, and it's still investing a lot. So you can't really use like price to free cash flow, because free cash flow can be all over the place. So I tend to pare it back to like price to gross profit, which is like, how to explain this in simple terms, is like the profit you earn based on like the cost of the thing. If I want to sell you the glass of water, well, it's not my own time, but I had to pay for the water and I had to manufacture the glass, and I sell it to you for like a small profit. That's like my gross profit on that glass, but it doesn't, account for my own time and the fact that I had to like do some marketing to get your eyeballs. So anyway, I feel like that's a somewhat useful valuation metric for Axon. And if you're on the YouTube, you can see like the green on the chart here, like on a price to gross profit basis, Axon's currently around 32 times gross profit. And when I was buying Axon like way back, it was more like 15 times gross profit. So in my view, it's overvalued, albeit it's kind of come down quite a lot. And I threw stock-based comp onto this chart as well, just to kind of show how ugly the picture is. Like the company's paying, essentially like the founder, Rick Smith, is paying himself more than 20% of revenue, not profit, revenue, as stock-based comp. That's pretty ugly. And it puts me off the company a little bit. So yes, like I think Axon is overvalued, but you do have to look at what the company's doing. And this is like the art of being an investor. Like, has the valuation changed for a fundamental reason? And to some extent, kind of it has. I hinted at it a few minutes ago. Like, it used to be considered a hardware company. And typically, like hardware companies have a lower valuation multiple because they have to like build physical stuff. And if you're a software company, you tend to get a higher valuation multiple because you're much more scalable. Like, I don't need to build 1,000 widgets if it's software. I can sell like 1,000 times what I have because it's just software, right? The marginal cost is quite low of selling like another bit of software. And so there is a good reason why Axon is trading at a higher valuation, but I don't know, it just feels still a little bit pricey to me. And that's like art. If you ask me to try and precisely create like a discounted cash flow model, I could do that, but I don't think that would tell you anything particularly useful.
No, what would tell us something useful when I'm looking at this chart, using a little bit of my technical eyeballs, one I see is that even after having come down quite a lot from what looks like two lofty peaks, it is still nonetheless at the high end of its historical valuation. Right. So the only question I would ask myself as a potential Axon investor is the company growing fast enough? Is something on the fundamentals going to accelerate the rate at which it makes money that would justify this still lofty price? If I could answer that with a positive, then I would say that the valuation is going to work itself out. If I can't be very convinced of that happening, then I would say stay away, because it's still very, very expensive, historically speaking, even after a correction.
Agree. And that is, I think, the like the train of thought you should have. It's much more accurate to look at an individual company and then try and form opinions informed by what the company's doing and informed by macro. But, don't draw big, broad conclusions and try and apply them and get some sort of sensible conclusion out of it.
Yeah, and Axon, every time I see an Axon chart, it pains me a little bit because we went on that one run and, you were telling me this is your number one bet right now. And of course, through silliness, Monkey did not take your encouragement urgently enough. And I know the company. I really, I think I understand it decently well, but I cannot for myself answer, no doubt on the level you can, I don't have the confidence in why their rate of growth will continue, onwards forever based on, your reverse dollar cost model. God, geez, what reverse
discounted cash flow model, reverse DCF.
Yeah, thank you, reverse DCF. But you who do have a fundamental understanding of their growth trajectory could probably justify why even at these levels it is a good enough investment, maybe.
You can definitely make an argument for both sides, but maybe coming back to my comment like half an hour ago, doesn't have to be black and white. You don't have to be all in or all out. Just own a little bit, and then at least it keeps your skin in the game, so you're encouraged to monitor what the company's doing. And if the valuation looks more reasonable, or if suddenly something changes fundamentally and they open up like huge new markets, which they might actually be doing, you notice that because you're reading the earnings reports every quarter, and you can start adding again.
Shall I tell you about Monkey's latest addition to the King of the Jungle portfolio, which took place late last week? Ticker is ODD. Company is Oddity. And this is very unusual company for me because it's technically known as a beauty business. I think, what's that other company? ELF, ticker symbol Alpha or Alta. The big broad thesis is that makeup and beauty products never go out of style, but still, it's not in my wheelhouse particularly. But something caught me eye on the big picture level is that they're combining that with AI image, call it the user is put through a gamut of, call it AI tests, pictures and snapshots and answers to questions. And then the company formulates a more fine-tuned product specifically for that user based on their skin tone and shade. So it's basically cutting out the middle person. I don't know much about the makeup industry other than people try to tell you this matches yours. You need some guy to help you, bring out that amazing deep sea blue of your eyes, whatever.
Could I quickly sidebar? My buddy Shen and I are like remorselessly competitive. And I think we're on like ski season or a ski trip in 2017. And we're in like LA after ski season. And we went to some department store and this lady had like some kind of gun that measures like your skin age. And we had $100 bet before we used the gun on who had the youngest skin. I look young, but that motherfucker had, I'll say that again, beat me out. But that MF had like 10-year younger skin, according to this lady's gun.
Well, so maybe you are a future Oddity customer. Anyway, that's the big picture. Really important. I want to shout out to our Patreon community again. Somebody pitched this. I'm sorry, I forget who it was. Somebody pitched Oddity in our community some months back. I would not have been looking at the stock were it not for that pitch. So Monkey squirreled it away, put it on his watch list, eventually got around to researching it, and saw things that he liked, but is like not good enough, right? It still didn't merit, an investment. But this is how things work, right? The company intrigued me enough to then start going deeper. And what I did over the holidays was I poked around the website and I said, Dad, this is actually really cool technology. And so I got Mrs. Monkey a gift gift card, whatever. She then picked her own stuff and then is really delighted with what she got. And it wasn't just makeup, it was actually wellness. They have a secondary business that is more about wellness, skin, not hair, whatever, vitamins and not just like superficial stuff. Anyway, that's the big picture stuff. But there's a reason I want to talk about this rather than it just being like, oh, I bought this share. More and more as I'm developing this options course, you'll hear me say this in the future. Time, or the variable of time, is crucial to understand and know and admit how you're using this. And there is such a thing as poorly timed investments. It doesn't matter how good the company is, as we were talking about Axon, right? Or how bad the company is. If you could somehow time your entry relatively intelligently, then you will be buying low, selling high, right? But of course, that's easier said than done. And so this is what you'll see here, Badge, is this is the chart that each candlestick represents a week. So it's going back to 2001. Basically, it's the history of the company's price. And immediately, Monkey saw something glaringly obvious, Badge, which is that line, he marked it with a blue solid line that basically runs through the middle of the screen. That line represents, in the history of this company, you could tell that that's the level at which price was either below and couldn't break, or above, which was its support. So it was either acting as the resistance to price or the support of the price. And there was, I guess it was 2 years ago, a big, massive peak in which the price went way, way above that level. And now, curiously, as I'm watching the price on the sidelines, in recent weeks, the price then dipped below that level. And once a massive level like that gets broken, you basically have to be thinking caution, caution, caution. For whatever reason, the market is saying something's not quite right. So that's when I started tracking just the price action and withholding buying. And then just last week, the price went below yet another level. You could see I had a second blue rectangle drawn. The price dipped below that and actually touched the third level. That's the lowest level on this chart. The price touched that level. As soon as it touched that level, Badge, that basically meant to me the following. Either this company is really, really broken somehow, and people are just continuously selling it, and the price is going to keep dropping. So if you were a momentum player, you would not touch this right now, because obviously the trajectory is basically straight down. But then when I went back to the fundamentals, and where Monkey goes to do all his fundamental research, you will see this company is basically firing on all cylinders. Revenue is increasing, free cash flow is increasing. There's a little dip, and that's actually because they're starting a third brand. So their investment in CapEx is increasing. So it makes sense that their free cash flow levels would dip. But this company basically could not be any stronger on the fundamental levels. So what we have here is Monkey's perfect marriage of real, it's not that he wants technical weakness, but what Monkey's seeing is that the price finally dipped to a technical level, which probably will start reversing soon because it really got down low enough, or the valuation just got so silly cheap based on the rates of projected revenue growth that even if it continues falling further, Monkey will just start dollar cost averaging. And so this is for our listeners, I think, my sweet spot in how I'm now investing, which is fundamentals plus technicals plus patience, and now watch to see if I'm right or wrong as my understanding of the company grows and I start listening to quarterly earnings and start developing more of a thesis.
That's great. And you know, I rail against like these chart guys who just look at like price action and try and form an opinion. But like you're doing what an investor should do. And you're going beyond that perhaps because you're actually going out and like subscribing, buying the product, trying out the service. Like it, you know, you're getting like your own anecdotal experience, plus you're looking at earnings reports, plus you're looking at like technical indicators. And I think together that can be quite powerful.
Yeah, and that's really I'm going to go on about this more during our options course, I promise you, because it's key. However, for this episode, I think the moral of the story here is I feel really good about my process because I did not take any shortcuts. And I'm combining tools, and when I combine them, I could feel that mystical problem of trying to get the timing right becomes more probabilistically set up in my favor. I just needed to be patient for a long time. And that's really the trick, you know, because it's hard. I was like, when I first discovered, really, to be honest, when our Patreon poster posted about this company, I was like, cool, this is the coolest thing ever, right? This is going to be a big winner. But what did the price do in the meantime? It kept dropping and dropping and dropping. And had I invested merely on, call it the hype, or because I liked what I saw, I would have lost a lot of money. And so this is a more, I think, professional grade approach. And it takes time to develop, but more on that soon.
It's probably a nice transition into like a bit of conversation around options and why the options course is certainly going to be useful for me. Because one of the things about options is it's not like you buy the stock and you own it. And if you can be patient, time frame sort of doesn't matter in some respects. Like as long as you can be patient. But when you buy an option or you sell an option, like there is a date. And that as that date approaches, like that affects the value of the thing you own. And so, I didn't get like wiped out or lose my pants, but I do have options expiring this Friday, the 16th of January, and like a couple of them are expiring worthless. Like I took a put on Quantum Computing Inc. because, I go on and on for the last year about what garbage these quantum computing companies are, and none of them are in the long run, are going to win. But like my bet on this company failing by January the 16th, 2026 was a sucker's bet because I've lost like 97% of my of the money I invested in that. And like my option to buy Coherus at $3, like that's expiring this Friday. That's lost like 99.5% of its value. So yeah, like you got to be right with options, but you got to be right with the time frame as well. So in your options course, you're going to give us like some proper learnings around that stuff.
Yes, and I could tell you the two big mistakes here, in hindsight, obviously, because had they worked out, you would have been a great genius, right? The two mistakes here are actually very obvious, and I don't know how avoidable they are in these two instances. They're different though. The mistake with Qubit Badge, because I was in the same boat with you, I just got out way earlier, is that the initial price for those options was too high. Meaning, technically speaking, the IV, which is how the option understands its price, was so elevated because any investor under the sun was basically looking at this saying, this is not a good company. So the market makers are like, yeah, we're going to charge you out the butt if you want to participate in this bet. And so even if you're right about all the other things, if you paid too much, it's going to be a losing proposition. So that's easy way to sum up that problem. The Coherus problem is a little more interesting because I too hold a lot of Coherus options about to expire, worthless. But here's a little bit. I don't know if it's an irony, but the major JP Morgan health conference that a lot of companies use as a kind of sales pitch for future mergers and acquisitions and basically shop talk in the biotech industry are actually taking place this Tuesday, I believe this Tuesday and Wednesday. In fact, Coherus, I believe, is presenting tomorrow at like 10:30 Pacific. The problem here is the great problem of all options holders is that you ran out of time unless this conference tomorrow basically save, like a last minute save, which has been known to happen in biotech because all they need to say is, like we're in some talks with whatever big company and the stock could shoot up 300%.
Right.
So
I need this stock to double to my option to be in the money. But it's like a $200 million company, so that can happen with like micro caps like that.
Of course, the real, to be more specific, the real error was once it got within 30 days, should have, to protect whatever was left in value, sold it and rolled it out to the future and not left it to the last week. But we'll talk more about. Yeah. And there are, tax gain losses, harvesting and all that. So there's ways in which it's not the end of the world.
Hey, so don't leave me on my own here, right? You made your own errors with Cipher. What happened there?
Yes. So, Badge, before going to bed last night, I was thinking about how I wanted to talk about this. This is going to take us a little off, not specifically about options only, but about our challenge, our community's Patreon King of the Jungle challenge and how we've set up our accounts. Because I realized the mistake I made was actually boneheaded in a very different way. Because we only, we deposit $200 a month, right? Our accounts are limited for now in size. I'm at 14K, you're at about 10K. That's still, call it small-ish, given that options require at least 100 shares of something to as either collateral or to sell calls. So basically more sophisticated stuff only happens when you have a larger amount, right?
Yep.
So at the start, Badge, I just got into a mental framework that says because we can't use margin in our accounts for this competition, I just don't have enough, call it collateral, to do call it secondary legs, which involves selling against collateral. So all I've done in our King of the Jungle so far has been buy calls, which is very risky. I actually have sold calls against EOS, but that's because I have 250 shares. So that's the only one position I could do that with. But in the Cipher example, I took a risky call and I actually had a big profit on it. And sometime last week, as I said to our patrons, Monkey's paw was hovering over the sell button and then greed won out because I was like, the technicals are great. And, this company, so I justified, I put myself through the paces. It's not like I was being laissez-faire. I was like, should I sell and take, but greed won out. Let's call it greed for short. So that's the main error. That's how I would answer your question literally, right? What was my mistake? I wanted even more than I already had. But the secondary thing I'm talking about was, here's what I should have done. I should have realized that once you buy a call, you nominally control 100 shares. From the perspective of the brokerage, even though I didn't have the shares, I only have 12 Cipher shares in my account. I bought the call, so I do control 100 shares, and I should have actually sold a call at a higher strike price, which would have worked against the 100 that I controlled by buying the call, and I would have actually profited. Money would have come into my account. It would have lowered my gains, but it would have also lowered my risk. My error, I didn't literally think of it. I didn't think, right, because I was in the mindset that I can't sell calls because of the initial limitations. It didn't occur to me, man. That is my error. Now, because I'm designing the options course, I'm like, duh, it wasn't a question of should I have bought or sold them. It should have been at that moment, I would have decreased my risk, taken risk off the table, and just threaded the needle in a much more sophisticated way. And didn't think of it. But believe you me, Monkey will be back, and I'll use more of these fancy double layers in the future.
Great stuff. I mean, I don't even understand the strategy you're describing. So look forward to being the guinea pig in your course, along with our like prototype batch of 8 Patreons, and we'll learn about this stuff with you.
Our very noble guinea pigs. By the way, if you're listening to us, Patrons, sorry for Monkey apologizes for not yet explicitly inviting you all because I've been in the lab, but do expect an email within a week or two saying, okay, let's iterate this first version of the course, and I can't wait to show it to you all. And then everybody else will get a larger invite once it's, out of legit beta.
And we're going to make this available to Patreons. So like if you're listening along and you're interested, then go check us out at wallstreetwildlife.com. And there's a whole bunch of Patreon tiers. It's not just the options course. This is some brand new initiative from Krzysztof, but there's like a whole bunch of other stuff happens there every day, like interesting alpha, market insight, conversation. If you're at our Dolphin tier, Krzysztof and I share in real time, like our actual trades that we're doing in our real portfolio, in like my retirement portfolio and in both of our King of the Jungle portfolios. Like we're just being transparent with our investing decisions and the lessons we're learning from them.
Yes, and even better, now, Badge, lest you forget, our patrons have their own portfolio that they are making the pitches for and then voting on. And right now, that portfolio too is whooping ass. And we are up to 6 companies, with company number 7 being solicited and voted on this month. So it's a learning process for everyone because, correct me if I'm wrong, Badge, it's one thing to listen to a podcast, and it's another thing to start rolling up your sleeves and taking your investing process more seriously and pitching an idea to community and then going through a selecting process and then tracking your results. It's not like paper trading anymore, right? It's something shifts when you become more active. So that is really a virtue, another unsung virtue of doing it this way.
And if you're on there and you don't feel up to making a stock pitch, like get involved in the voting anyway. And there will still be merch and recognition for Patreons who voted for their stocks in general that drove like the main returns of the community portfolio.
You know what? I just wanted to check in this moment, our top selection, which was brought into the portfolio in December, is up 34%.
Great stuff. Is that by any chance Novo Nordisk?
It is indeed. It is indeed. Yeah, good on you, Badge. Good on you. Something happened with them. It was some big fundamental news recently, right? And was it have to do with the Amazon pharmaceutical partnership or something like that?
I haven't really drilled into the Amazon news, but Amazon Pharmacy in the US are now selling like oral weight loss drugs. But it was the drugs themselves. Like I've been buying steadily Novo Nordisk for coming up for a year now, maybe nearly a year, because I wanted like to build the income investing side of my portfolio. But very clearly, like there's a huge untapped market for these weight loss drugs. I've got friends now who are on them, right? They're incredibly beneficial. Like, there's pros and cons, there's side effects. But if you're trying to conquer like an addiction, which might be like a food addiction, like these are incredibly helpful pharmaceuticals. Some people are they're just going to be resistant because you used to have to inject yourself like once a month. Go get jabbed from your GP or do it yourself. And now it's pill form. You take like a pill every day and like the weight starts dropping off. So like, to my mind, it was like a no-brainer that was going to massively expand the adoption of these therapies. And yeah, like the pills got released in the US maybe like a week or 2 ago. And now like the stock is re-rating. Sometimes investing is easy. Like
Although yes, and in hindsight, everything is not only easy, but like the most obvious thing. But sometimes investing is easy. In this case, you know, yeah, seems like it. So right on. So I guess Monkey's last pitch to our listeners is check us out on the YouTubes. But above all, we encourage you to check out our Patreon Wall Street Wildlife community and be active in your comments if you're lurking in the shadows, because you don't know where a little bit of alpha will come from, as in the Oddity example. Forgive me, Patreon, I forget who you were that pitched me that idea or pitched us that idea, but thank you.
Awesome stuff. I'm just going to mention again before we close, like our partners at fiscal.ai. It is an incredible tool. I use it every day. Krzysztof uses it every day. They have just repriced their their premium tier, Enterprise, is now significantly cheaper. Like, go check it out if you're interested in building your own models, downloading financials, being able to look at like as reported versus real metrics. It's a really, really powerful tool. If you use fiscal.ai/wildlife, you'll get a handsome discount and that'll help us out. So yeah, like even if you go use the free tool, like this will up your game as an investor.
All right. We always end the show with, are you ready to become a beast and an investor? I don't know. That's kind of getting weary on me. I just want to end this episode by saying, Badge, don't kill yourself on the ski slopes. I need you at the poker tables in Vegas in March. So I don't know how good badgers are on ski. You know, I always see them sniffing around acorns rather than like going 100 miles an hour down some black diamond. So
there you go, 78 miles an hour. That's my record speed so far.
Oh,
100.
damn. Okay.
But yeah,
so
badgers are pretty good on skis. Yeah. That's not much of a closed out line though, Krzysztof. If you're going to pitch me like, you know, I do like, are you ready to become a beast of an investor? Your journey starts here. If you want to pitch me a different close, like now is your chance.
If you want to be a beast of an investor, don't die on the ski slopes.
Okay. I don't think that one's going to have longevity, but whatever. Thanks for joining us for another week. Krzysztof and Luke, over and out.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.